What's up, outliers? Thanks for hanging out for a few extra minutes. Had to make sure that the pup is fed and happy. Today's stream, we're just going to look at a few things actually pretty quickly. So I want to talk about Palantir, GameStop, ASTS, and it's because I have positions in all of them. So I have a vested interest in knowing what's going on. So that's really the game plan. So let's first start with Palantir just because it's really cracking off. So coming into earnings, we see that it is literally running all-time highs. And we also see that right now earnings is slated for the 4th after the close. So I was just eyeballing what kind of behavior is going on in the options market coming into this. And this is a really cool example of a stock that's very well developed at this point. What that means is that there's tons of people that have big equity positions built into this thing. So deciphering the options flow actually gets more complicated in names like this. And that's largely because there's now a ton of additional reasons why traders are trading options in this name. Some of them might be buying puts, but really they're net long because they have more shares. So then if you see some put buying activity, that might just be some sort of carry hedge, not necessarily an expectation of a drop. I'm not necessarily seeing that here, by the way. I'm just saying when stocks get to this size, deciphering what's going on in the options market becomes more challenging. This is actually why in names like this, the implied volatility surface, the vol surface, is way more useful. And then you kind of use those two data points in conjunction with one another to help create a much better picture, clearer, of what might be going on in here. So let's take a quick look at just what the general market flow has been into this name, PLTR. Okay, not ETH-A, PLTR. That's gotten me so many times where I type in a name and hit enter and then it just reverts back to something else. So, I mean, this is still looking pretty bullish, right? So we can see supporting net long call premiums and then actually net short puts. And so this looks like actually a lot of put selling. So people probably trading different kinds of cash secured puts, looking to gain entry into the name. The upcoming earnings will be really interesting, I think. And it's because this stock really has been like parabolic. It's gone haywire in the last few weeks, really, right? So you can see from here, what is this, 22 July? It started at 146 and now it's closed at 159. So that's a pretty healthy move over the course of just a few names, especially in the kind of stock that really is starting to grow pretty massively. So you can see that it continues to exhibit really strong momentum. It hasn't even been around for 5 years yet, but at this point it's up 496% over the last year. So if we compare that against something standard benchmark SPY, I mean, it's not even in the same ballpark. And small caps essentially are struggling for their lives right now. So this continues to look good to me. That's really the long and short of it. I actually built out my position a little bit more in this specific stock. I'm still trading a ratio call diagonal in here. We spent a little time reviewing some of this. We'll go a little deeper on the stream tomorrow into like the specific positions, the thought process behind how I'm building out the ratio call diagonals, but it all summarizes to the fact that I'm generally thinking bullish. That's mostly what we're seeing here. Haggis says everyone in this now could have bought at $10 like a year and a half ago. Yeah, so there's actually a really cool tool to help us to investigate where the transactions have happened. So most of the transactions in the stock have happened at the 25 handle, but there's a, leave yourself alone. There's two notable nodes below that, one at like the 17 handle and then another at like the 9 handle. That's where we see most of the people getting into this over the last, really over the lifespan, right? Because it came out of the gate a little bit hot and then it got sent down until it started securing deals. Then in 23, mid 23, we saw it start gaining life. And notice how, again, this is why earnings are so important to pay attention to. Notice how when this stock starts really surging each of these legs, it's attached to an earnings release, right? So earnings here, this thing starts rallying out. Earnings here starts rallying out. Earnings here starts rallying. Earnings here, so on and so forth. This isn't like some sort of magical thing that I'm showing you. This is literally just how stocks are priced. And this is why most of the time you can actually appreciate most of the movement through earnings or following earnings. But this is also why if you wait until earnings, you can miss a lot of the move because most of these are gapping after the earnings. So if you're waiting until after the earnings release to gain entry, you're typically a little bit late. So that's Palantir. Looks solid. Let's take a quick look at ASTS. And this also still looks pretty good. I don't love the pullback here. It's a little too aggressive, I think. So this is, what is this move? It opens. What? Let me click, bro. Let me live my life. Why would you not let me click? All right, fine. We'll do it this way. It's like a 9.5% move down to up. Yeah, 9.8%. So that's a little bit outsized. Now, again, like that's pretty common in stuff like this, just because these names tend to have higher vol, right? So if we take a look at the average daily range over the last 5 days, it's 7.9%. Like these are things that move a lot. So it dropping a little high on that, again, is not great. That represents a negative 2.5, 2.5 standard deviation move to the downside, 2.5 sigma move. So that's large. And you can see over the last 6 months, that's the largest of the type that we've seen. Now, it is still hovering around the 10-day MA, which I like. But really, for me, the behavior now really needs kind of have to pay pretty close attention to how this thing moves. Now, it has earnings on the 11th after the market. So let's take a quick look at what's been going on in ASTS. And a little bit different, right? So we can see that after this big drop, there was actually a lot of heavy call premium coming into this big drop that actually continued for a little bit before it started selling off. A lot of this sell-off is probably people rolling out, but this is still a little bit more bullish than what this would have led me to believe. So an important point to take away from that is, again, like as companies get a little bit bigger, it gets more difficult to extract out the information and the informed trading element becomes more challenging. That's why using stuff like options flow, I think, well, it can be informative in just about everything, but I think you really get the best bang for your buck when you're in smaller names dealing with informed parties that have some sort of unique information about the stock. This, to me, looks like, mispriced. We can take a look at what that volume was. Maybe they're playing this a little further out in time, and then this is just a drop in the bucket. That would be my broader guess, but we'll take a look at that. So yeah, so here it's a lot of closing out the front and moving out in time, which again, I think you have to expect that. This looks good. General accumulation, I don't love that. Net negative, but then this shows net positive, like back to accumulation. So that I don't love. This is kind of funny. This is like really bad timing. It might just be some profit taking from these names that got in when it was like sub 5. That's interesting. Let's take a quick look at vol. We just want to see what the surface looks like. So yeah, I mean, it's still obviously pricing in right now this earnings release. That's why you see the front so peaky, and you can see the backwardation essentially across those following expiration cycles before we go back into contango from like 42 to 56. This is strange that there's backwardation from 56 to 84. Again, that's relatively abnormal. That's something that can be traded from a vol perspective. The smile here looks... It's interesting that the calls are a little bit more expensive than the puts. I find that a little bit strange, especially where this thing is right now. So that's a little strange. The fact that the lower strikes are higher than the higher strikes, again, that's fairly standard, especially for the put side of the equation, for the out of the money puts. But the fact that these are as high is a little bit anomalous. And I mean, it still maintains pretty strong risk premiums. Yeah, you can see it trades pretty fat on 30-day. That's what this is measuring, is 30-day vol for risk premiums. And then this becomes vol of vol. That's interesting. We'll have to take a look at that. This would be cool if they let me just pick a certain number of strikes. So these are cheap here, which is the 51.5s, 5 days. These obviously are super expensive. Let's take a look at percentiles. So, fascinating. The front is super, super cheap. 7 days at 12 in terms of IV percentile. So that's plummeted. Whereas we're seeing a steady rise further out in time. That's very cool. So yeah, there's like a collapse in the front, which is also very strange because in the front, it's had this down move up like a pretty fair gap down. So again, that in and of itself is fairly anomalous. OI changes. I don't want percent. Let's do raw to start. So the 90s are getting built out. I'm assuming these would be pretty far out in time. That's generally unit building. 58 puts. That's interesting. The 53 and the 52s, that makes more sense to me. Total OI, way more calls than puts, pretty much across the board. One AUG is a little bit of an exception. 15 AUG, this is pretty strong positive skew, I think, for earnings expectations. Haggis says, what platform do you trade on? I use Thinkorswim. That's what you actually see in the background here. And now let's take a quick look at GameStop. About as flat as it can be. A couple things in GameStop. I do see vol is starting to creep up ever so slightly. It's not because raw vol is going up, but it's because old vol is trickling off of the window for calculating implied volatility percentile and rank. So this is just normalizing essentially for this period of highly, highly, highly compressed vol post earnings. I mean, vol here is about as low as I've seen it for a really long time. It's all, I mean, it's not even triple digits. It's fucking sub 80. which again for GameStop, that is exceedingly low. Open interest across the board is a little skewed to the call side, but again, not super heavily. The other thing that's very different now is a lot of this OI is not in the front. This is, again, when GameStop starts getting really active, you'll see almost all of this be in the front. And right now, it's just the fucking polar opposite is clearly not in the front. So, I mean, this looks like all quiet on the Western front. That's mostly what I see here. Haggis says, do you think there are dark pools? I mean, that's not like an opinion thing. It's an objective truth. We know there's dark pools. Dark pools get a really, really bad name, but they're really not as nefarious as people think they are. I think most people literally just don't understand. They hear the word, and it's like the same thing with like assault rifle, right? Like you hear a word, and then we think that there's, you know, something going on overall. And so like if we take a look at GameStop just to pick something, like this is the dark pool, right? Like we can see what's going on in the dark pool. And there's a specific use for the dark pool that isn't, again, like highly nefarious. A primary reason is to allow larger trades to go through and not be front ran, to start moving price massively. Because if you try to do this on the open exchanges, a lot like this here, like this trade would get front ran super hard because we would all see it and essentially try to trade the expected price movement. Now, again, I'm not saying that there's nothing wrong with dark pools. There is. Off-exchange volume ultimately is not the pure expression of what a market is designed to do, which is to match supply and demand. So this creates an artificial function. However, another thing a lot of people don't know about the dark pools is that this still hits the consolidated tape. It's not like it's not internalized orders. That's a completely different thing. So this will still hit the consolidated tape. There's just typically a delay, and it's like a second or 2 seconds. Now it can be a little bit longer than that, sometimes up to like 10, but it's not even like that long of a delay. It's just a few moments. So anyways, yeah, it's like dark pools. It's not really like a thing of, like, do we think there is? There absolutely is. That's, you can read about them. It's not like some hidden thing. It just has a suggestive name that I think tricks a whole lot of people. That's what I think. Bishu says, hey there, Eric. I come from crypto futures. Okay. Recently started getting into options due to gains on option. Hold on. Okay. Looks like a covered call at the money is the exact same as a cash secured put at the money in terms of outcome of on stock movement. Yeah, I mean, generally. So if we take a look at ETH A, just because I had that up and it's on my mind. If we take a look at building a covered call position, I have to build it separately. And then if we compare that to an at the money short put, let's take a look at the difference. This is what the covered call looks like. Take a look at the numbers that you see here. So if the stock goes up 15%, you're up 142. If it's down 15%, you're down 275. Let's take a look at what it looks like in this context. If it goes up 15, you're up 157. If it goes down, you're down 245. So in the like gross muscle movement, it's effectively very, very similar position. the actual numbers are not going to be the exact same because it really depends on where you get filled on stuff and what slippage is there. But yeah, I mean, I think that that's about the same. There's also slightly different implications in terms of cash, like how much money is being used in overall capital efficiency, which is another note. But yeah, I mean, overall, pretty similar. Haggis says, do they move everything to XRT? Could you expand on that, Haggis? I know that a lot of people have a lot of hypothesis about XRT's involvement in this broad thing. And I'm actually very curious the way that you're looking at it. My expectation is that you probably have a pretty representative view of, I'm guessing, what a lot of people are probably guessing or thinking. So I would be very interested to know. When you say, do they move everything to XRT, what do you mean? Hey, yo, Reese, what's up? And then rational evidence. Let me know if that answers your question. Bishu says a few recommendations from other stock channels as far as your content. Where do you recommend start? Hold on, I'm confused. Oh, I see. I took using my own trading TA and a few recommendations from other channels. As far as your content, where do you recommend starting? I understand now. Go through the playlists, I guess. That would be the best place because it's at least organized generally by topic and thought. Yeah. But it also depends on like just what you're trying to do and what you're trying to learn. If it's just options in general, then there's an entire basics playlist about options. Haggis says, one of the few ETFs that volume is large enough with derivative that has GME. Yep. No, I'm familiar with what XRT is, Haggis, but I'm curious what you mean when you say, do they move everything? Who is they and what is everything? Right? Like, what do those two things mean? Because my guess is you think that there's some sort of shell game going on with XRT via rehypothecation of shares. And I think your instincts are, if that is the case, are largely correct. And I think that we can see that happening, the rehypothecation of shares. So that instinct is correct. But Haggis says hedge funds. That, I think, is the broad misconception. I don't think hedge funds are moving anything into XRT. XRT is a structured ETF. It has a specific mandate based on what it's designed to do. So if we take a look at XRT ETF, we can literally look at the prospectus. Hey, yo, what's up, Joe? Good to see you, man. I hope you guys are having a good weekend. Are you back home now? Or are you still up north? Sure. Yo, just let me in, dog. So let's take a look at their actual documentation. And we'll do the summary prospectus because honestly, the prospectus typically is a little bit annoying to read. So what this means is this is kind of like a business plan. This says what the fund does. So in this case, we can see what this thing is meant to do and what specific percentages it's meant to hold. So there's obviously nothing being moved into or out of this. It's a fixed thing. Now, Haggis says T plus 35 failure to deliver. Yeah, okay. I figured it was. So the one thing I would mention to you, Haggis, on this is, one, good on you, right? Because you're trying to explore ideas, which is super important. The thing I would mention to you on this, though, is that you have to be really, really thoughtful about understanding the underlying components of these, because there's a lot of implications. So in the context here, like T plus 35 failure to deliver, that is very little, if anything, to do with a hedge fund. That has to do with market makers, which are just completely different entities. Hedge funds more often have some sort of discretionary or just investing mandate that they're looking to execute for their clients. So they're not making markets. So the failure to delivers is generally related specifically to market makers in this context. So that being said, there is absolutely some sort of game going on between locates and actual shares. That we know. I don't think that game is going on because they can't get the shares. There's an abundance of shares now. There used to be a completely different scenario where shares were hard to get and they were expensive to get for hedging activities and stuff like that from market making. So that part aside, there's a huge difference, though, between the different ways that they play the game, because there's one trying to do stuff from the sense of being as efficient as possible. There's a second element where they can't actually get the shares and they're trying to find some sort of way to move about it. So I would differentiate between those. Haggis says market makers are banks. They're not. Market makers are a different entity. So the way to think about market makers is they're kind of like the intermediary in broader markets. I actually think I might have a graphic. One sec. I don't know if I do, but I might have a graphic. I don't, not like a specific graphic. I have this that shows you different entities that exist in the markets. So different kinds of participants. So when we look at market makers, they're typically considered on the sell side. Sometimes they're part of really big financial firms like Citadel. And Citadel also has other activities they engage in through asset management, hedge funds, stuff like that, in addition to the market making arm. Now, again, theoretically, they're disparate pieces of the business, kind of like larger conglomerates that just have multiple components. Now, that obviously looks really bad and raises a lot of questions when you do have a market making arm on top of, the hedge fund arm that again, that doesn't look right to me. But that's a broader topic. The DTCC is a completely different entity. So right now, to me, it looks like you kind of like heard some terms from different places and are trying to glue them together, which again is good. But yeah, I can see that there's a lot of confusion though between the participants. The main thing that I would recommend on that is there's a really great book that is called like Trading Exchanges. It's old. That's the only downside, is that it's a little too old. I'm trying to grab the book for you. Yeah, this is the old girl. This one. So this book, it's old. So you kind of have to read it in the context of what it is. However, this gives a really, really good look inside the way markets actually operate, and then the groups in between the markets. Haggis says, does the DTCC know the difference between market makers and banks? Of course. I can't tell if you're trolling, which is fine. You can have fun. Or like if you legitimately are asking that. And I don't mean that with any sense of disrespect. I'm just trying to make sure I understand the lens that you're looking at this stuff from. But yeah, absolutely. Defensive says, can we look at UNH? Yeah, let's fucking take a look at some UNH, dog. Give me 1 sec. I'm gonna grab another water really quick. BRB. All right, we good. Yeah. Hold on. Haggis says legit no trolling. Okay, cool. Yeah, and that's totally fine. I just want to make sure that I'm understanding the questions and then the perspective. But yeah, so with the DTCC, they're essentially a different entity. Kat says DTCC is owned by its member participants, of which Citadel is one. So DTCC. I'm essentially asking Gemini for like a tree for us to look at. So regulation of DTCC and subsidiaries fall to the SEC. So the Securities Exchange Commission oversees the activity of the DTCC components, which is the Depository Trust Company, DTC, the National Securities Clearing Corporation, NSCC, and the Fixed Income Clearing Corporation, FICC, which are all registered as clearing agencies with the Commission. The Financial Stability Oversight Council, FSOC, that's actually kind of fun. It's like a military term. We have like all different kinds of special operations commands with SOC in the end. So this sounds like that. Has designated these DTCC subsidiaries as systemically important and The ownership of DTCC lies with its principal users. This unique ownership structure means that the corporation is owned by a wide array of financial institutions, including banks, broker-dealers, and mutual funds. This user-owned and governed model is designed to ensure DTCC's services are aligned with the needs of the industry it supports. The corporation operates on an at-cost basis, with any excess revenue being returned to the member firms. So, yeah. That's like I actually think a really great answer by Gemini. So yeah, the DTCC is full well aware of like the difference between market makers and banks, for sure. Okay, so I said we were going to look at UNH. Let's see. And then you had more. Wondering if you see any potential trades worth taking with earnings on Tuesday. Yeah, okay, let's take a look. So this is a fun question. I like these trade modeling questions. So the first thing is let's start with like the standard trade development process, right? So that starts with just a quick review of like what the current landscape is. So for example, we know healthcare has been doing very poorly. So if we take a look at the healthcare ETF XLV, when this loads down here, you'll see that over the last 6 months, this thing has been really collapsing. So that's something that I keep in the back of my mind when I'm looking at, when I'm looking at the main components of the sector, which UNH is one of them. So what I mean by that is if we take a look at this tab, we go into healthcare, you'll find UNH right here. So UNH is a major component to the healthcare index. So that tells me something. Now, UNH has been getting crushed. It had bad press here, that led to gap down following its earnings release. Then it had follow-on bad press here between the 12th and the 13th, leading to another gap. And now it's been consolidating there with a trail down coming into earnings. That is super, super interesting, because most of the time when you have names coming into earnings like this, the price actually starts to stabilize, go sideways, not trail down in this way. This is strange. So all of those things stick out to me. My immediate hypothesis is long-term momentum short, probably. We can see over the last 12 months, it's down 49%. So that negative momentum, I believe, is likely to continue, but that doesn't mean that there's not near-term opportunities to other directions. The other thing that I see here is fat risk premiums, really fat, consistent risk premiums. And I mean, this is stable, really, really stable. We're seeing the slow, steady climb of vol coming into earnings, which is exactly what we would expect to see. And if we take a look at the overall positioning here, first, let's start with the vol surface. When does it have earnings? 29th before the market. Okay. So this will be the closest. What I'm doing is I'm measuring the upcoming volatility smile against others. And I'm looking at the variance between them. So like this is interesting to me in that at the monies, there's such a wide gap between these, 79 versus 60%. That's a 20-point vol difference. So the next cool thing we can do is we can actually extract out what the vol is priced in for earnings itself. So I have a calculator that does that for me. Give me one sec. So current spot price is 281.06. Oh, wait, hold on. I think it's actually on this so that you guys can see it. Yeah, here we go. Yeah, this is legit. So spot price is 281.06. The underlying vol I'm not going to use. The underlying vol is 53. I'm just going to use the following term vol, which is 62.53. And the term vol is 83.3. Days to expiration on that term is 6 days. So what I can do is literally calculate what the market is expecting. So the event vol for this is about 148.6% for that individual day. That's what the expectation is. So, I mean, significant vol on a relative scale, which we'll be able to double click into. If I take a look at the total options chain, there's definitely upside expectation. You don't see this kind of configuration without that. But more importantly, let's take a look at what includes earnings, which is very bullish. 72,000 calls against 42,000 puts is nuts. The other thing that's very bullish about that is that this is still a big stock that is held by a lot of people. And what that means is very frequently we would expect to see a lot of hedging activity coming into earnings, meaning heavier put side. So the fact that this is not that is very telling. Defense says same, feels like something big is coming. Yeah, we'll be able to see. We'll be able to see what the buildup is. Kat says, do you mess with small and micro caps ever? Yeah. I mean, ever is a good way to put it, right? Because that's pretty all encompassing. infrequently for sure, but sometimes. The problem is, especially with microcaps essentially no. But small caps, depending on the size of the company, because remember, small caps, don't let the name confuse you. Small caps a lot of times are still pretty big, right? So if you think a small cap, what is like 250 million to 2 billion, there's some big small cap companies. So in names like that, a lot of times there's enough vol and there's enough OI for it to make sense in order to put on like a reasonable size position. But it's just a lot of times with small caps, it doesn't make sense because it's very, very difficult in order to get decent sized positions on. I mean, I run into that even when I'm trading earnings on large cap stocks, where it can be difficult to get a fill at the price that I want. And I actually have to break up my orders, which is not the end of the world, but it's also not as efficient as I would like to be. So with something like microcaps, the only time that I would really do anything in there is more to test ideas. It's not because it's something that's like viable for the portfolio in terms of like relative sizing and stuff. It genuinely just stems from having some sort of curiosity or seeing a market effect that I want to try to turn into a profit mechanism, and then just trading it in a minimal viable product size. So if I'm trading something like a smaller microcap, more often than not, it's grossly undersized, but it's more I'm trading it out of interest versus this is like some sort of logical fit for the broader portfolio. ZXborg says, general question, how do you construct a trade to take advantage of IV crush over earnings? I have an entire video on this, so I will show you. ZX, this video will walk you through essentially how to trade earnings in overall. The Cliff Notes version is there are a handful of very discrete effects around earnings. There is the pre-buildup of vol. We literally just spent time during the pro live stream, the skill development stream on Thursday, going through this like in detail. And it's because there's a lot of different ways to trade earnings from a functional sense. We actually like paper traded one of them through a cycle to give a comparative look at how these can behave. But essentially you can trade the vol buildup coming into earnings, the IV contraction post earnings. You can trade the catalyst of earnings on an intraday basis. And then you can trade the drift that follows the earnings release. All of those are pretty targetable. So let's take a quick look at the options market in UNH. I mean, it's not like leaping out at me bullish. There's definitely some semblance of bullishness, but not like super strong. And there's a lot of long put premium, net long put premium coming into this. So I don't necessarily think a whole lot from that. I'm just curious what the financials look like. So revenues are steadily growing. I'm really curious what the latest issue is with them. Let's see what happened really quick out of curiosity. I think we looked at this before, but the 12th of May or the 13th of May. I have to go to Gemini. What happened with UNH on the 12th/13th of May? There's obviously some sort of news event around it. It's just my little news tool here doesn't go back enough in time on a really known name like this. Okay. Okay. So the CEO left. surprise announcement of the immediate departure of CEO Andrew Whitty. Company simultaneously announced the suspension of 2025 financial guidance. I see. Yeah, big catalyst. Dramatic turn of events followed a period of mounting pressure. The departure of the CEO and withdrawal of financial forecast led to legal repercussions for the company. Triggered the filing of a class action lawsuit who alleged suffering damage due to misleading statements, failure to disclose the full extent of the company's financial challenges. Adding to the woes, DOJ is investigating its Medicare billing practices. Yeah, I mean, that's a crapshoot. So the interesting thing, though, again, let's think about this as traders. If I were first, I'm going to write, how do I do this? I'm going to write in the Discord what I'm going to guess you guys are going to vote so that you know I'm being legit. Do me a favor, vote in this poll. The question is, what direction would you trade UNH earnings release? Would you trade UNH to the upside or to the downside? So far, 4 votes split, 3 for up, 1 for down. $60-40 now. Let's see if we can get to 10 votes. 5 more people. 6 votes, now split 50-50. Down to 5 votes, back to 6. Now we definitely need a couple more votes because we can't end this tied. To the upside. Okay. So this I'm looking at, it's actually more split than I thought, which is pretty good. So here's the reality. You can trade this, I think, either direction. The reason is there could be an argument made to trade this to the upside, whereas we're essentially thinking it in the lens of the bad news. The bad news is priced in. So then if there's more bad news, the proverbial floor might be limited. Here's the problem. I think the bad news in here still shows us that the total severity of the bad news is unknown, which means that there's going to be a lot of vol. Now, if you wanted to trade to the downside, I think that can safely be done via some sort of short call component, not necessarily expecting a bunch of downside velocity, but more trading it from the lens of not thinking it's going to rally hard, right? Same position, kind of 2 different frames of thoughts and 2 different ways that that position would manifest. That all being said, I actually would think that one of the better ways to trade this is actually to trade the vol itself, to not worry so much about what direction this thing might go and to see if there's an opportunity wrapped into the volatility side of stuff. Because that was, I think, the original question about UNH, which was wondering if there's any potential trades. So in this context, I do think that there's several ways that this could be traded. Now, if we take a look, let's get a sense, we can see the volume, but let's get a sense of, again, what the options market is telling us. So I want to go no more than like 10 days out. I don't know if it's just loading or if I broke it. Try 20 days. Okay, so that works. 10 days doesn't. Let's try 15. 15 days works. So this, I mean, is exceedingly telling, right? So you can see the strike price here. We have really fat vol as we get lower. Then the vol really sinks at the monies. And then the vol really starts to ramp as we get further out of the money. But the vol is still pricing more severity potential to the downside, which again is absolutely what I would expect to see. I think that that makes the most sense. And you can see this, though, reflected essentially across the entire surface from the 5 days to expiration to the 12 days to expiration cycle. So this configuration, again, completely logical, in my opinion. If we take a look at the overall changes in raw vol, front vol is starting to skyrocket. Medium term vol is still about flat. And then my guess is if we take a look at this, which is the risk premium, the risk premiums post this drop are so fat, insanely fat. So this to me would be something that I probably will trade. We're actually going to spend time on the pro market prep stream tomorrow, taking a look at all the earnings plays, because we've done that most of the pro prep sessions, because earnings is like realistically a big part of what I like to trade. And it's because it's statistically viable. And so far, it gives us a really, really good uncorrelated return source. So what I'm doing is I'm grabbing another tool really fast to just take a look at how UNH behaves around earnings, generally speaking. Now, this being said, let's see. I'm just grabbing my historic data on it because I definitely have traded UNH for earnings. Yeah, this earnings season so far has been really, really solid. I'm just around 40 trades with a 74% win rate and actually a more solid than I expected P&L. The problem here is that, as always, the average loss on most earnings plays does tend to be like pretty damn extreme. And that's literally just because of how earnings plays go. That's just the absolute normal path for those. But still, that being said, this earnings season so far has been good. So now let's take a quick look out of curiosity at the prior occurrences with UNH. So UNH generally is profitable for me. Take a look at its latest earnings, though. I remember we explicitly held off on the latest earnings. So eyeballing what we see here, it's been outside the expected move most of the time. So outside, 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 outside. This one is outside technically. This one is outside. This one is also outside. So out of the past 12 moves, there's a disproportionate number that are outside for sure. Very interesting. So this, I mean, is probably something that I would be less interested in touching, because here's the other issue I have. I don't think this is enough vol. So I would need to see how effectively the vol build out into the release ends up being, because this is not enough to compensate for what I would consider to be the potential move here. My guess is that it will actually be much higher than this as it gets closer. So if I price out the vol myself really quick for the event, so we already did this. The expected move that we're pricing is like 7.5% in terms of what's priced into the options markets. So that looks a lot better. Reese says, if vol is underpriced, would you go long? No, not in this case. Just because vol is underpriced doesn't mean that it's going to expand, which is what you need. Realistically, going into an earnings release, holding long vol can work sometimes, but you're like definitely swimming upstream, because most of the time there's going to be a significant contraction of vol post earnings. So if we take a look at a visual of that for you here. So the orange is implied. Notice how most of the instances through earnings, the implied is coming down. And that's just the natural order of things. Because coming into an earnings release, we are uncertain. We don't know what's coming down the pike. We know new news is going to be entering the system, and that new news absolutely has the potential to move things. And then after earnings, that news is now known. It's no longer an unknown. We have an idea of what's going on, and then we can price things more effectively. Now, this prior release is actually really, really interesting, because, I mean, take a look at the change in vol coming into earnings and then post earnings. It actually expanded, which is, again, this is abnormal. So I actually remember trading vol to the downside following the release. A big part of trading is creating a context window to understand like what is normal, and then being able to identify what is abnormal. And then when you see things that are abnormal, there's a bunch of different ways you can get involved. So yeah, very curious. But all this being said, for earnings, like for me to trade earnings in this, I would need to see more vol. So to do that, really what I would do is just monitor the front vol, not just the entire term vol, by the way. Like, I'm actually mostly interested in the actual at the money, because the at the money vol is going to be lower than the term vol, right? So if I take a look at the average between these, what is it? 61 and 59. So the average here is actually 60% vol, not 62.56. If we use the actual straddle, not the entire term, right? Because the entire term is going to get skewed for the out of the money and in the money options as compared to the straddle, which the straddle is a really good proxy for what an expected move is. And there's actually a lot of really, really good math behind why that's the case, and how the straddle, specifically when you run the implied move from the straddle using the deflator, like the 80% deflator. But this will probably be a really interesting earnings release regardless. So it's definitely one I'm going to pay attention to, whether I trade it or not. But it's absolutely a potential to be traded. There's, as most stuff with earnings. If we take a look at what's coming up on earnings this coming week, there's a ton of shit. So right now, this is focusing on stuff that has weekly options. And we have BYON, Nucor, Tilray. I mean, there's just a ton. There's literally an absolute ton. And then if we get rid of the weekly filter, but we still maintain an optionable filter, I think the full session options might be the best. Any increment option? No, that's going to get rid of too many big names. I'm surprised that it doesn't have other choices for options. It would be actually really nice if it had some sort of liquidity filter here. That would be great. None with full session options based on their filters. Huh. Oh, wait, is this a watch list? Oh, you can overlay scans. That's cool. So we can actually build this super fast. So let's build a custom option scan that lets us literally this one. No, not this one. What is this one? This one's just for unusual options activity. We could use this as the backdrop though. So we can do volume OI. We don't need this. We don't need this. We need some sort of other option proxy. For activity. Volume is okay, but not ideal. OI is kind of, I think OI might be the best choice that we have. So let's save this filter really quick. This will just be earnings. Earnings filter. And then let's go back and then add in. Oh, damn. It only allows stock. Wait. Yeah, it only allows stock. So then let me try that one more time and see if we can do something like that via the stock side of the equation. Let's get rid of that. We'll do, oh yeah, we could do the options shit here. This is perfect. So we want OI at least 3,000. We can add stock price at least $3. And then we can add stock volume. And we probably want at least like 250,000. Maybe a little more generous, maybe do like 200,000, see what we come up with. Okay, so now we'll save this. This will just be, again, the same. Earnings, watch list, filter. Save that. And now we should be able to overlay that here. Bam. Sick. So now we can see a fuck ton of them. Of which there is a fuck ton of them. We definitely want confirmed earnings. Wonder if there's a way to filter that out. Anyways, there's a ton of shit this week, man. So normally the way that I go about trading earnings is I'll apply my general filter first. So again, my general filter is using weeklies. This gets me into stuff that it's not only just to trade the front expiration. You can do that for stuff that doesn't have weekly options, and that's still okay. But it's really to trade stuff that is active enough. We want mostly active names so that you have stuff that actually has liquidity in it, right? Because if we take a look at, I'll just grab a couple randos from this list so that we can see what pops up. Let's take a look at CDP. So this should have at least 3,000 OI, so that filter's not working for some reason. Volume is 493. Let's take a look at how liquid these front options are. Oh, this is a REIT. Hold on. Let's grab something else. What do you think? HTO? So this it apparently is not filtering successfully. But this is also saying HTO call, so this is doing something really weird. It does have options and the whole thing's not loading. So I wonder if TOS is undergoing an update. It does that sometimes on the weekends. Jesus. But I mean, this thing has good vol edge. So yeah, this is one of those names that would definitely be added to the list. There's a ton of choices. ZXBorg says even underpriced vol will get crushed though. It depends. It depends on where the vol is, because not all vol, again, as you develop experience as a trader, you have to understand that there's a lot of different vols, right? So if we take a look again at whatever we were looking at before, UNH, right? When we look across the volatility surface, we're literally seeing this real time. We're seeing all of the different vols that exist. And we're seeing the relationship of those vols relative to one another. So in this case, we're looking at strike vols across different terms, which is, again, I think something that is probably not as well understood, but it holds a lot of really useful information for us. So in this scenario, if we have UNH, and if we look at UNH term vol, for example, if we're out here 174 days, which is right now 46.89% vol, following the earnings release, this might not move literally at all. It can move depending on what comes out, but it might not move at all. So differentiating between term vols is important, because when we say underpriced vol might contract, it might contract, but it does depend heavily on the term for sure. So then ZXBorg says, so going long, still going to lose half your profits even if your direction is right, I think. You can't conclude that. So you can't conclude that you would lose half your profits, and you can't conclude that you would lose money. Both of those, you can't make those assumptions based on this scenario for ZXBorg. Because again, there's a reality where vol could go up. We saw that in an instance when we look at this. This right here, vol went up. Look at the orange line is upward sloping. So there's no guarantee that vol is going to go down. Then you add the complexity of multiple term vols. And then we add the complexity of what the individual position is and what it needs. So for example, you could buy vol here via long puts and you would have made a ton of money. You could have bought vol here via long puts and you still would make money, even with the vol contraction. That's my guess. I don't know that for a fact, but let's take a look actually and see how accurate this is. I like doing exercises like this. I think it's good. So this was not last, not 2, but 3 ago. This one. So let's go to 14 oct. Wait, what year was that? It would have been last year. October 14th. And let's see. So this is right now loading the oh man, I got all sorts of people riled up on X, which is hilarious. Or on Reddit. Oh, I love this. This is perfect. So this is not loading for some reason. I do think that they're probably updating stuff. Yeah, this is no dice. All right, gang, that wraps me up. Be an outlier. See you guys later.